What is a dividend? How do dividends work? What are the benefits of dividends? What are the downsides of dividends? And how is your dividend paid to you? These questions will all be answered in today's video on dividends. So, a dividend is a cash payment from a company to its shareholders. This payment is a portion of the profits for a company. A dividend can either be accepted as cash or used in a dividend reinvestment plan. And I'll be making another video on dividend reinvestment, so I won't go into that a ton right now. Dividends are great because they're added money that you receive from a company on top of the appreciation of their stock price. If you opt to receive a cash dividend payment, this will just be added to the balance of your brokerage account. If you decide that dividend reinvestment is the way to go for you, then your broker, for me it's Fidelity, will automatically purchase the amount of shares or portions of shares equivalent to what the dividend was. So if I get an $8 dividend from Realty Income, which is a $50 stock, Fidelity will purchase 1/6 of a share of Realty Income for me. So dividends tend to be paid out by larger companies that are growing at a slower pace. So think Procter & Gamble, ExxonMobil, AT&T, and Johnson & Johnson. So since they're growing at a slower pace, it means that they don't need to invest all of their profits into growth, so they have available capital after they've paid for everything, and they use this for their dividend. Most companies determine dividends based on how much money they have left over after everything is paid, and then give this out to shareholders. However, some companies are known for their dividends and attract investors because of their high and or stable dividend payments. Companies that have increased their dividend yield for over 25 years are known as Dividend Aristocrats. These are companies like AT&T or Colgate. For these companies, maintaining and increasing their dividend is a necessity because it is what their stock is known for. So, in some cases, these companies will take out debt to pay their dividend if they don't have a strong free cash flow. This isn't ideal for the financial health of the company, but companies know that if they cut their dividend, there will be a massive sell-off of their shares. In this way, a dividend almost becomes similar to a debt payment for these companies. Instead of being a payment of the leftover cash, for these companies, the dividend is paid, and then they see if there is leftover cash to invest into their business. For these reasons, a high dividend payment can oftentimes be straining on a company and stifle growth. It is important for a company to find a happy medium with its dividends and what they are investing into their growth. When looking for a dividend stock, it is important to look at their free cash flow and make sure that the company isn't taking on debt to pay their dividend. This can be a sign of a dividend that might not be safe. If you have any questions on dividends or anything else, leave a comment down below and I'll get back to you. Also, if you have any specific videos that you would like me to make, comment that as well and I'll be happy to make a video for you. Thank you for watching. Please remember to like and subscribe.